If you have ever looked at the financial markets and wondered why some investors seem to always come out ahead, while others, even the very intelligent ones, keep making costly mistakes, then what Howard Marks has to teach you will change the way you see investing, the way you see risk, and most importantly, the way you see yourself as a decision maker in an uncertain world. Howard Marks is one of the most respected investors alive today. He is the co-founder of Oak Tree Capital Management, a firm that manages vast amounts of institutional capital across many types of asset classes, with a particular focus on credit markets, distressed debt, and what are broadly called alternative investments. Over a career spanning more than 4 decades, he has navigated some of the most turbulent episodes in financial history, from the inflation of the 1970s to the stock market crash of 1987. From the collapse of the technology bubble in the year 2000 to the global financial crisis of 2008, from the sovereign debt crises in Europe to the market dislocations of more recent years. Through every one of these episodes, his investment firm has produced results that his peers and competitors deeply respect. And through all of it, he has been distilling his thinking, his observations, and his hard-won lessons into a set of ideas that are not just about how to pick good investments, but about how to think clearly, act wisely, and manage risk honestly in a world that is always uncertain. These ideas are what we are going to explore today, and they begin with a single, foundational insight: the idea of second-level thinking. Before we get into the substance of that idea, it is worth spending a moment to understand what kind of person Howard Marks is and why his perspective carries such weight. He is not someone who shouts predictions on financial television or claims to have a magical formula that guarantees profits. He is, above all, a thinker, a careful, methodical, deeply honest thinker who is willing to confront the most uncomfortable truths about investing, including the truth that most people, most of the time, are not capable of consistently generating returns that are better than the overall market. He is willing to say that out loud, even though his entire business is built on the premise that he and his team can do exactly that. And the reason he can say it without contradiction is that he has a clear, rigorous framework for why most investors fail to add value and what the rare investors who do succeed are actually doing differently. That framework is what we are going to explore, and it starts from the very first concept, which is the one that sets the stage for everything else. Most people who invest in financial markets approach investing in a relatively simple and instinctive way. They ask straightforward questions. Is this a good company? Is the economy growing? Is the management team strong? Are profits rising? Is the stock in an upward trend? These seem like reasonable questions. And in many contexts in life, answering reasonable questions correctly leads to good outcomes. But in financial markets, answering these questions correctly is not enough. In fact, answering them correctly does not reliably lead to good investment results at all. And the reason for this is one of the most important and counterintuitive insights in all of investing. It is this: in financial markets, the price of any investment already reflects the collective wisdom and expectations of all the investors who have analyzed it. So if you correctly identify that a company is excellent, but every other investor has also correctly identified that it is excellent, then the stock price already reflects that excellence. There is no profit to be made by recognizing what everyone else has already recognized. This is what Marx calls first-level thinking, and it is the thinking of the average investor, the thinking that, by definition, produces average results. Second-level thinking is something entirely different. It is harder, deeper, and more complex. It requires you to think not just about what is happening, but about what the market already expects to happen, and then to ask whether reality is likely to diverge from that expectation in a way that creates an opportunity. A first-level thinker looks at a company and says, "This is a great company. I should buy the stock." A second-level thinker looks at the same company and says, "This is a great company, but is it as great as the market currently believes it to be?" Is the stock priced so high that even if the company continues to perform well, I will earn only a mediocre return? Or is there something about this company that the market is underestimating, some dimension of its quality or its prospects that the collective wisdom of all the other investors has not yet fully captured? That second set of questions is what second-level thinking looks like in practice, and it is what separates the truly exceptional investors from the merely competent ones. To appreciate just how different first-level and second-level thinking really are, consider a concrete example. Imagine that a major pharmaceutical company has just reported very disappointing clinical trial results for what was expected to be a blockbuster drug. The news is terrible. Analysts are cutting their estimates. The stock is falling sharply. Every financial journalist is writing about the disaster. A first-level thinker sees bad news and stays away, or perhaps sells if they already own the stock. This is an instinctively sensible response. Bad news means avoid. But a second-level thinker asks a different question. The question is not simply whether this is bad news. The question is whether the market's reaction to the bad news has been proportionate, or whether the stock has fallen so far and so fast that it now represents a genuine bargain relative to the value of the company's other drugs, its pipeline, its manufacturing infrastructure, and its future potential. In other words, has the panic created a price that is lower than the true intrinsic value of the business, even after accounting for the bad news? That is the second-level question. And answering it well, getting it right more often than the other investors who are also thinking at the second level, is what generates genuinely superior investment returns. Marx is emphatic and honest about something important here. He does not claim that second-level thinking is available to everyone. He does not suggest that by reading about it and understanding the concept, any investor can immediately become a superior investor. In fact, he argues the opposite. By definition, most investors cannot consistently think at the second level, because if they could, their collective intelligence would become reflected in market prices, and there would be no advantage to be gained from it. The number of investors who are genuinely capable of second-level thinking, who have the analytical skill, the knowledge, the emotional discipline, and the intellectual independence to consistently see what others are missing, is small. This is not an insult to average investors. It is just a mathematical truth about how competitive markets work. But it is an important truth to understand, because it shapes the strategy you should follow. If you are honest with yourself, and you genuinely cannot identify a specific source of analytical or informational advantage over other market participants, then your best strategy is probably to invest in low-cost index funds that capture market returns without the costs and risks of active stock picking. There is nothing second-class about that approach. In fact, it is the approach that the majority of data suggests beats the majority of active managers over the long run, after accounting for fees and transaction costs. The honest recognition of your own limitations is itself a form of superior thinking. But if you are serious about developing genuine second-level thinking, about building the kind of investment framework that gives you a real edge, then you need to go much deeper. You need to understand markets not just as financial machines, but as human systems driven by human psychology. You need to understand risk not just as the probability of losing money, but as a multidimensional concept that encompasses the full range of possible outcomes. You need to understand value not just as a number, but as an estimate that is subject to uncertainty and revision. And you need to understand cycles, both economic and psychological, not as events to predict, but as forces that shape the environment within which every investment decision is made. These are the themes that Marx develops in rich detail throughout his teaching, and they are the themes we are going to explore together now. Let us begin with the concept of market efficiency, because it is fundamental to understanding when and why second-level thinking can actually add value. The efficient market hypothesis, which was developed by academic economists in the 1960s and 70s, states that financial markets are very good at incorporating all publicly available information into asset prices. Because there are so many intelligent, motivated investors constantly analyzing stocks and bonds and other financial assets, and because new information spreads almost instantly to all participants through modern communications technology, it is very difficult for any individual investor to consistently find assets that are mispriced relative to their true value. Any obvious mispricing gets corrected almost immediately as multiple investors notice it and trade on it, driving the price back to fair value. This theory has a lot of truth in it, and any investor who dismisses it entirely is making a serious mistake. The history of investing is littered with the wreckage of investors who thought they could easily beat the market, who believed they had superior insights that the collective intelligence of millions of other investors had somehow missed, and who discovered, often at great financial cost, that they were mistaken. The market, as a collective entity made up of countless intelligent, well-motivated, well-resourced participants, is a formidably tough competitor. Its collective intelligence, processing information in real time and expressing it through billions of daily transactions, is in many ways superior to the intelligence of any individual. But Marx does not accept the efficient market hypothesis in its strongest form, the form that says markets are always right about the price of every asset. He believes, based on both theoretical reasoning and decades of practical experience, that markets are mostly efficient, but not perfectly so. There are degrees of efficiency that vary across different types of markets, different time periods, and different market conditions. The major stock indices for large, well-known companies in developed markets are highly efficient. Hundreds of analysts cover every major stock. Information is widely available. Competition among investors is intense. In these markets, it is very difficult to find a persistent edge. In contrast, markets for high-yield bonds, distressed debt, small company stocks in obscure industries, securities in emerging markets, and other less widely followed asset classes are less efficiently priced. Fewer sophisticated analysts are competing. Information is less evenly distributed. The average participant is less skilled. These markets offer more genuine opportunities for the diligent, skilled, contrarian investor to find assets that are priced below their intrinsic value. Beyond differences across markets, Marx also observes that even highly efficient markets go through periods of significant inefficiency, and these periods arise not from a lack of information, but from a surplus of emotion. When markets are gripped by extreme fear or extreme greed, investors stop making rational, information-based decisions and start making emotional, psychology-driven decisions. They sell assets regardless of their value because everyone else is selling, and the fear of loss is overwhelming. Or they buy assets regardless of their price because everyone else is buying, and the fear of missing out is equally overwhelming. These periods of emotional extremism create pricing errors that can be substantial and that can persist for extended periods before rational pricing reasserts itself. These are the periods when the most exciting investment opportunities arise for the patient, disciplined, contrarian investor. Think of the financial crisis of 2008. During the acute phase of that crisis, in the autumn of 2008, investors were selling essentially everything, regardless of quality or price. High-quality corporate bonds were selling at prices that implied default rates many times higher than any historically observed rate. Stocks of well-managed, financially sound companies were trading at fractions of their underlying book value. Entire asset classes were being dumped at prices that bore no rational relationship to their fundamental worth, simply because investors were panicking and needed cash. Anyone with the capital, the courage, and the analytical framework to buy during that period made extraordinary returns over the subsequent years. The opportunity was not created by a lack of information. Everyone could see that prices had fallen dramatically. The opportunity was created by the emotional state of market participants, by the fear that was overwhelming every other consideration. This is the key insight about market efficiency that Marx wants investors to hold on to. It is not that the market is always wrong or that it is easy to beat. Most of the time, the market is approximately right, and competing with it is extremely difficult. But sometimes, at moments of extreme psychological stress or extreme psychological euphoria, the market makes significant errors. And recognizing those moments, having the conviction to act on them, and having the capital stability to hold until the error corrects itself is the core of what genuinely superior investing looks like. Now, let us move into the concept of value, which is the bedrock of Marx's entire investment philosophy. At the most basic level, every investment has two numbers associated with it. One is the market price, meaning the price at which you can buy or sell it today. The other is the intrinsic value, meaning its true worth based on the underlying economics of the asset, typically defined as the present value of all the cash flows the asset will generate over its lifetime. These two numbers are sometimes equal. Sometimes the market price is higher than the intrinsic value, and sometimes the market price is lower than the intrinsic value. Investment opportunities are created when and where the gap between these two numbers is large enough to be interesting. The concept of intrinsic value is powerful, but it is also deeply uncertain. For a simple, short-term bond issued by a highly credit-worthy government, the intrinsic value is relatively straightforward to calculate. You take the scheduled interest payments and the principal repayment, discount them back to the present using an appropriate interest rate, and you have a number that most analysts would agree is close to the true value. But for a common stock, the calculation is far more complex and far more uncertain. To value a business, you need to estimate how much cash it will generate in the future, for how many years, and at what rate of growth. You need to estimate the competitive dynamics of its industry and how they will change. You need to estimate the quality of its management and how effectively they will deploy capital. You need to estimate the macroeconomic environment it will operate in. And you need to discount all of these uncertain future cash flows back to the present at an appropriate rate. Every one of these inputs involves significant uncertainty. Change any of them meaningfully, and you get a very different intrinsic value estimate. Because of this inherent uncertainty, different skilled analysts will arrive at different intrinsic value estimates for the same business. And this is actually a good thing from the perspective of creating opportunities, because it means that the market price will sometimes diverge significantly from any particular analyst's estimate of intrinsic value, even when all the information about the business is publicly available. The analyst who has built a more accurate model, who has understood the competitive dynamics more deeply, who has a more realistic view of the growth prospects, will arrive at an intrinsic value estimate that is meaningfully different from the consensus. And if that difference is large and in the right direction, it creates an opportunity. Marx emphasizes that the concept of intrinsic value is not a precise number. It is a range, an estimate, a rough approximation. And because it is uncertain, investors must build in what Benjamin Graham called a margin of safety, meaning they must buy assets not just at prices below intrinsic value, but at prices significantly below intrinsic value. The margin of safety serves two purposes. First, it compensates for the possibility that your intrinsic value estimate is wrong. If you think a business is worth 100 and you buy it at 60, and it turns out the business is actually worth 80, you still made a good investment. But if you bought it at 90, thinking you had a 10-point margin of safety, and it turns out the business is worth 80, you now have a loss. The second purpose of the margin of safety is to compensate for time. Even if your intrinsic value estimate is exactly right, it may take much longer than expected for the market to recognize that value and push the price up. During that waiting period, you need to be comfortable holding the investment, which means you need to have bought it cheaply enough that it does not feel painful to hold, even when nothing seems to be happening. The critical insight that Marx draws from the concept of value and the margin of safety is perhaps the single most important practical lesson in all of his teaching. It is this: good investing is not about finding good assets. It is about finding assets at good prices. These two things are completely different and are frequently confused, to catastrophic effect. A great company at a too high price is a bad investment. A mediocre company at a sufficiently low price can be an excellent investment. The quality of the underlying asset matters enormously for the long-run fundamentals, but the price you pay determines your actual return, regardless of quality. This is why Marx is so focused on the relationship between price and value, rather than on either price or value alone. An asset is interesting not because it is high quality, or because its price has risen, or because everyone is talking about it. An asset is interesting because its price is below its intrinsic value by enough of a margin to compensate for uncertainty and to offer a genuinely attractive, risk-adjusted return. This insight goes against the grain of what feels natural in investing. Human beings are naturally drawn to quality. We want to own the best companies, the strongest brands, the most innovative businesses, and there is nothing wrong with that instinct in isolation. Quality businesses do tend to grow faster, generate more cash, and compound value more effectively over time. But quality alone is not sufficient. If a business is universally recognized as the best in its industry, every investor wants to own it, which drives the price up to reflect that quality. At some point, the price gets so high that even the excellent underlying business cannot generate enough return to justify the price paid. The investors who bought earlier may have done very well, but the investor who buys at a too high price, even in a truly excellent business, is destined for disappointment. Buffett has a related saying that Marx appreciates. It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. But even Buffett's formulation requires that you pay attention to price. And in practice, the most exceptional risk-adjusted returns often come not from wonderful companies at fair prices, but from thoroughly ordinary or even troubled companies at genuinely wonderful prices, meaning prices so far below intrinsic value that the margin of safety is very large. This is the territory that Marx has spent most of his career in, buying assets that are unpopular, misunderstood, or temporarily distressed at prices that reflect not their true worth, but the market's fear or ignorance. This brings us naturally to the topic that Marx considers most fundamental of all, and which he says is the most misunderstood concept in investing: risk. The word risk is used constantly in financial conversations, but it is rarely defined carefully. Most people, when they talk about investment risk, mean one of two things. Either they mean the probability of losing money, or they mean the volatility of returns, meaning the degree to which an investment's value fluctuates up and down over time. The academic finance world has largely settled on volatility as the standard measure of risk, partly because it can be calculated mathematically from historical price data, and partly because it fits neatly into the mathematical models that economists like to work with. Marx rejects volatility as a meaningful measure of risk for a practical investor. He argues that volatility is at best a symptom of risk, and at worst, a misleading indicator of it. Consider two investments. Investment A is a stock that fluctuates wildly in price, sometimes rising 50% and sometimes falling 40% in a single year. Investment B is a bond that trades at a very stable price with almost no day-to-day fluctuation. By the volatility definition, investment A is very risky, and investment B is very safe. But suppose that investment A is a business generating enormous free cash flow with a strong competitive position, trading at a dramatic discount to its intrinsic value simply because the market is temporarily ignoring it. And suppose that investment B is a bond issued by a company that is fundamentally insolvent, but whose financial troubles are not yet widely recognized, so that the price is still stable. In that scenario, the volatile investment A is actually much safer in terms of the risk of permanent capital loss than the stable investment B. The volatility of A is noise, not risk. The apparent stability of B masks a genuine risk of permanent loss. This example illustrates the key distinction that Marx draws between the risk of permanent capital loss and the risk of temporary price decline. Permanent capital loss is the true enemy of the investor. It is the scenario where money that you invested simply does not come back, where a business fails and the stock goes to zero, where a bond defaults and the recovery is minimal, where leverage forces you to sell at the worst possible time and you cannot benefit from the eventual recovery. This is the risk that must be managed above all else. Temporary price decline, by contrast, is simply the normal noise of markets, the fluctuation of prices around intrinsic value that creates the opportunities for patient, disciplined investors who can buy when others are selling in fear. The deeper point about risk that Marx makes is that risk and price are inseparable. You cannot assess the riskiness of an investment without knowing the price you are paying. An investment in a very unstable, highly leveraged company might be extremely safe if you buy the debt at 20 cents on the dollar. Because even in a very bad scenario, you might recover 30 or 40 cents, which is still a profit. The same debt bought at 90 cents on the dollar is extremely risky because even a moderately bad scenario produces a large loss. The asset itself has not changed. The business is the same. What has changed is the price, and with the price, the entire risk-return profile of the investment. This leads to what is perhaps the most important and counterintuitive insight in Marx's entire framework about risk. It is this: risky assets bought cheaply are less risky than safe assets bought expensively. The concept of safety in investing is not about the nature of the asset itself. It is about the relationship between the asset's characteristics and the price at which it is acquired. Government bonds are generally considered the safest of all investments. But if you buy government bonds at a price that implies extremely low future returns, and interest rates then rise significantly, you can lose a substantial portion of your capital in real terms. On the other hand, a distressed company's bonds, bought at a deep discount that provides enormous margin of safety, might be among the safest investments available, because even the worst plausible outcome still results in a reasonable recovery. This is why Marx is so deeply skeptical of the common investor wisdom that says you should hold safe assets when markets are uncertain and risky assets only when things look good. In practice, the time when everyone agrees that assets are risky, the time of maximum fear and uncertainty, is precisely the time when assets are most cheaply priced and therefore most genuinely safe for the disciplined investor who buys them at that price. Conversely, the time when everyone agrees that assets are safe and the outlook is bright, the time of maximum confidence, is precisely the time when assets are most expensively priced and therefore most genuinely risky for the investor who buys them at that price. Marx uses this insight to define what he sees as the fundamental paradox of risk in financial markets. He states it simply and powerfully. Risk is highest when it is perceived to be lowest, and lowest when it is perceived to be highest. In periods of genuine market calm, when credit is easy, asset prices are high, and everyone is feeling confident about the future, investors relax their standards. They pay higher prices. They take on more leverage. They invest in things they do not fully understand because the returns on safe assets have become too low to meet their needs. And in doing so, they accumulate enormous hidden risk, risk that is invisible, as long as things keep going well, but that will reveal itself with brutal force when the environment changes. In contrast, in periods of genuine market turmoil, when prices are falling, credit is tight, and fear is dominating every conversation, investors abandon their willingness to take risk entirely. They sell assets at any price to reduce exposure. They hold cash or the safest possible instruments. They refuse to look at anything that involves any uncertainty at all. And in doing so, they abandon the field at precisely the moment when the risk-adjusted opportunities are most attractive, when prices are lowest relative to intrinsic value, and when the genuine risk of permanent loss is smallest for the disciplined investor who is buying rather than selling. One of the most useful practical tools that Marx has developed for thinking about risk is what he calls stress testing. Before making any significant investment decision, he wants to understand not just the expected outcome, meaning the most likely scenario, but the full range of possible outcomes, including the worst cases. He wants to know what happens to this investment if the economy goes into a severe recession. What happens if credit markets seize up and the company cannot refinance its debt? What happens if the management team makes a series of poor decisions? What happens if a competitor disrupts the industry with new technology? None of these scenarios might be likely, but they are possible. And if any of them occurs, what does the investment look like? If the answer is that even in the worst plausible scenario, the investor would lose at most a moderate amount of money, and the core capital would remain largely intact, then the investment has a genuine margin of safety. If the worst plausible scenario involves catastrophic losses, then the investment is genuinely risky, regardless of how attractive the expected case looks. This stress testing mentality is deeply unfashionable. Investment pitches are almost always built around the optimistic case, the bull case, the scenario where everything goes right and the investment returns many multiples of the capital invested. Bear cases are mentioned briefly and dismissively, if at all. The entire cultural bias of the investment world pushes toward optimism, toward the exciting upside, toward the narrative of growth and success. Marx swims determinedly against that current. He wants to understand the downside first. He wants to know the floor before he gets excited about the ceiling. This is not pessimism. It is not a refusal to take risk. It is the right way to think about investing in a world where the future is always uncertain and where unpleasant surprises are always possible. The investor who has genuinely analyzed the downside and is comfortable with it, who has bought at a price that makes even the bear case tolerable, is free to participate in the upside without the paralyzing fear of what might go wrong. The investor who has only focused on the upside and has never thought carefully about the downside is the one who panics when things go wrong, selling at the worst possible time and turning what might have been a temporary loss into a permanent one. Let us now explore one of the most intellectually fascinating parts of Marx's work, his analysis of the nature of investment cycles and their implications for strategy. Marx is deeply interested in cycles, and he has thought about them more carefully and written about them more insightfully than almost any other investor. His fundamental observation is that virtually everything in the economic and financial world moves in cycles rather than in straight lines. Corporate earnings cycle up and down. Economic growth cycles through expansion and contraction. The availability and cost of credit cycles from easy and cheap to tight and expensive. Investor risk appetite cycles from hungry to satiated to fearful. Asset prices cycle from undervalued to fairly valued to overvalued and back again. These cycles all interact with each other in complex ways, and understanding them, even approximately, is one of the most powerful tools available to a thoughtful investor. The key insight about cycles is that they are self-correcting systems. The forces that drive a cycle upward are the same forces that eventually create the conditions for its reversal. Consider the economic cycle. When the economy grows strongly, companies hire more workers, invest more in equipment and facilities, and borrow more money to fund expansion. Consumer confidence rises. Spending increases. This creates more demand, which leads to more growth, which leads to more hiring and more investment. The cycle reinforces itself for a period, but eventually, the expansion creates the seeds of its own correction. Companies have built too much capacity, They have hired too many people. Debt levels have become too high. When growth slows even slightly, all of these excesses need to be worked off. Companies cut back, lay off workers, stop investing. Demand falls. Growth slows further. The correction has begun. The same dynamic applies in financial markets, often in a more amplified and dramatic way. When asset prices are rising and returns are strong, more investors are attracted to the market. More capital flows in. More risk is taken. Standards for investment quality get progressively relaxed as everyone competes to deploy capital. Prices rise further. Then, at some point, prices have risen to levels that imply very low future returns or outright overvaluation. Leveraged investors who borrow to amplify their returns start to face difficulties. Credit conditions tighten. Some investors start to reduce exposure. Prices begin to fall. Others, seeing their portfolios decline, sell in a rush. The decline accelerates. The cycle reverses. What makes this analysis practically useful, rather than just intellectually interesting, is that these cycles have observable characteristics that can help investors gauge roughly where they are in the cycle, even if they cannot predict precisely when the turning point will occur. When you are in the late stages of a bull market, certain things are characteristically true. Valuations, meaning the price you are paying per dollar of earnings or cash flow, are typically well above historical averages. Credit is widely available on easy terms. Investors are confident and optimistic, even complacent. New, speculative investments are being launched and attracting capital. Stories about extraordinary market opportunities and surefire winning strategies are everywhere. People who have been cautious about markets are feeling embarrassed and under pressure to get more invested. These are the signs of a market that is late in its cycle, where risk is high, even though it does not feel that way. Conversely, when you are in the late stages of a bear market or a financial crisis, different things are characteristically true. Valuations are well below historical averages. Credit is tight or unavailable. Investors are fearful and pessimistic, refusing to consider any investment that involves risk. Stories about permanently changed conditions, about why this time is different and why markets will not recover, are widespread. People who have been cautious are feeling vindicated. The investors who were fully invested at the peak are suffering painful losses. These are the signs of a market that is late in a downturn, where risk is genuinely lower than it appears, and where patient, disciplined investors with available capital can find extraordinary opportunities. Marx is very careful to note that none of this constitutes a precise forecasting tool. He does not claim that observing late cycle characteristics allows you to predict exactly when the market will turn. Markets can remain overvalued for much longer than almost anyone expects. Cycles can extend further in either direction than historical precedent would suggest. The investor who sells everything because markets look expensive and sits in cash, waiting for the crash, might wait many years and miss substantial additional gains before the correction eventually arrives. The goal is not precise timing. The goal is awareness, the general awareness of where in the cycle you are, and the adjustment of your risk-taking accordingly. Marx has a memorable phrase for this. He says that you may not know where you are going, but you should know where you are. At any given time, a thoughtful analysis of the current investment environment should tell you roughly whether you are in a period where the pendulum is toward the risky end, meaning enthusiasm, high prices, easy credit, and complacent risk-taking, or toward the opportunistic end, meaning fear, low prices, tight credit, and excessive risk aversion. This knowledge should inform the overall positioning of your portfolio, even if it cannot tell you the precise timing of any market move. This concept of the pendulum is one of the most powerful metaphors in Marx's work. He describes investor psychology as a pendulum that swings back and forth between two extremes. At one extreme is excessive optimism or greed, where investors believe that the future will be permanently better than the past, where risk seems low and returns seem certain, where anyone who expresses caution seems foolish and is told they are missing out. At the other extreme is excessive pessimism, or fear, where investors believe that things will only get worse, where risk seems overwhelming and any investment seems dangerous, where anyone who expresses optimism seems naive or deluded. The critical insight is that the pendulum very rarely rests at the midpoint, at the position of calm, rational assessment of risk and reward based on fundamental value. It is almost always in motion, swinging from one extreme to the other, and it spends most of its time closer to one of the two extremes than to the middle. This is because human emotions, the fear of losing money, and the desire for gain, are not quiet, moderate forces. They are powerful motivators that push investors toward extreme behavior, especially when they observe that everyone around them is behaving in the same way, and when the financial consequences of short-term decisions, in terms of their portfolios and their professional reputations, are large. The practical implication is that the thoughtful investor should always be thinking about where the pendulum is at the current moment. Is investor sentiment unusually positive? Are people borrowing to invest more than they normally do? Are investment standards being relaxed? Are new speculative vehicles being created to meet investor demand? If so, the pendulum is somewhere toward the greedy extreme, and the prudent response is to reduce risk, increase margin of safety, and resist the temptation to be swept along by the enthusiasm. Conversely, is investor sentiment unusually negative? Are people refusing to invest even in obviously sound assets? Is credit completely unavailable even for high-quality borrowers? Are excellent businesses trading at fractions of their fundamental worth simply because no one wants to be in the market? If so, the pendulum is toward the fearful extreme, and the brave, disciplined, contrarian investor has an extraordinary opportunity. The challenge, of course, is that acting on these observations requires going against the emotional grain of the moment. When the pendulum is at the greedy extreme and enthusiasm is everywhere, it feels deeply uncomfortable to be cautious and conservative. You see others making money. You feel the social pressure to join in. You second-guess your own careful analysis. And when the pendulum is at the fearful extreme and pessimism is everywhere, it feels terrifying to be buying assets that everyone else is selling. Your own portfolio is probably declining. The news is uniformly bad. Every narrative suggests that things will only get worse. Acting with courage in that environment requires a combination of analytical conviction, psychological fortitude, and the long-term perspective that is genuinely rare among investors. Now let us talk about one of the most important and most difficult aspects of successful investing: the need to be genuinely contrarian in your thinking and your actions. The word contrarian is sometimes used loosely to mean simply being pessimistic about markets or skeptical of conventional wisdom. But Marx means something much more specific and much more demanding by it. He means the willingness to act in direct opposition to the crowd when your analysis, your valuation work, and your assessment of the investment environment indicate that the crowd is wrong. It means buying when others are selling in panic. It means selling, or at least being cautious, when others are buying with excitement. It means holding positions that everyone else considers dangerous and avoiding positions that everyone else considers safe. It means being willing, day after day, to look different from the crowd, to explain decisions that the crowd thinks are foolish, and to wait, sometimes for years, for your analysis to be proven right. Why is this so incredibly difficult? Not because contrarian thinking is intellectually hard to understand. The concept is quite simple. It is hard because it goes against every one of our most powerful social and psychological instincts. Human beings evolved as social creatures who survive by cooperating in groups. Our instinct, honed over millions of years, is to watch what others in the group are doing and to follow their lead. In most areas of life, this instinct is rational and healthy. If everyone in your group is running in the same direction, there is probably a good reason to run with them. If everyone in your community avoids a particular food, there is probably a reason to avoid it. Social conformity is generally adaptive, but in financial markets, social conformity is lethal. The crowd's behavior drives prices, and prices that reflect the crowd's consensus already have the crowd's wisdom and the crowd's errors baked into them. Following the crowd means paying prices that the crowd's behavior has driven to levels that reflect the crowd's enthusiasm or fear rather than fundamental value. And that is exactly the wrong thing to do. The psychological pain of being contrarian is real and significant. When you are holding a position that is declining in value, while everyone else seems to be making money by buying different things, the temptation to capitulate and follow the crowd is enormous. When the financial press is writing stories about how a particular asset is overvalued and destined to fall, and you are buying more of that asset because your analysis tells you it is cheap, the social pressure, the criticism, and the self-doubt are all working against you simultaneously. Most people cannot endure this kind of psychological pressure for extended periods. They eventually capitulate, either buying what the crowd is buying near the top or selling what the crowd is selling near the bottom. And in doing so, they destroy most of the value that a patient, disciplined contrarian approach would have generated. Marx has observed over his career that the best contrarian investors share a set of psychological characteristics that allow them to maintain their positions and their conviction under these pressures. The first is intellectual confidence, meaning a genuine belief in the quality of their own analysis, grounded not in arrogance, but in a deep, careful study of the fundamentals. They have done the work. They have built the model. They understand the business or the asset deeply. And because they understand it deeply, they can maintain conviction when the market disagrees, because they understand that the market's disagreement is based on emotion or incomplete information rather than on superior analysis. The second characteristic is indifference to short-term reputation. The professional investment world is deeply status conscious. How your performance looks relative to peers and benchmarks in the short term has enormous consequences for your career and your ability to retain client capital. This creates a very powerful incentive to make decisions based on how they will look in the short term rather than on what is genuinely correct for the long term. The investor who cares deeply about short-term relative performance will inevitably make decisions designed to manage that perception rather than to maximize long-term returns. The investor who has the clarity and the courage to focus on long-term outcomes, even at the cost of short-term embarrassment, is the one who can truly take advantage of contrarian opportunities. The third characteristic is patience, which Marx emphasizes repeatedly as one of the most important and most underrated qualities in all of investing. Contrarian positions often require extended periods of waiting before the market recognizes the mispricing and closes the gap between price and value. During those waiting periods, the investor is sitting with an unrealized loss, or at best, a flat return, watching the crowd continue to be wrong and feeling the pressure to give up. The investor who can wait, who has the capital stability and the psychological fortitude to hold through the uncertainty, is the one who ultimately captures the full return that the mispricing represented. The investor who cannot wait, who sells before the gap closes, realizes only the cost of the mismatch without ever receiving the benefit. The fourth characteristic is what Marx calls the ability to think about risk and reward honestly. Most people systematically underestimate the risk of the popular and overestimate the risk of the unpopular. They feel more comfortable owning what everyone else owns, even if the price is too high, than owning something that is feared or ignored, even if the price is very attractive. The contrarian investor must be able to override this comfort bias, to evaluate risk based on the actual relationship between price and value, rather than based on how comfortable the investment feels. Marx makes an important qualification to all of this. Being contrarian does not mean being reflexively negative or automatically taking the opposite position to whatever is popular. Blindly opposing the consensus is no smarter than blindly following it. There are times when the consensus is right, and the consensus price reflects a correct assessment of the situation. The contrarian investor does not disagree with the consensus simply for the sake of disagreeing. She disagrees when her careful analysis tells her the consensus is wrong, when the price reflects an overly pessimistic or overly optimistic view of the asset's true prospects. The contrarian label, properly applied, describes someone who is willing to act differently from the crowd when the evidence supports doing so, not someone who is always opposed to whatever the crowd is doing. Finding genuine bargains is one of the most practically important skills that Marx discusses, and it is intimately connected to the contrarian perspective. He defines a bargain not as a cheap-looking asset, meaning one whose price has fallen recently, but as an asset whose current market price is meaningfully below its intrinsic value. This distinction is critical. Many assets fall in price and continue falling. A declining price is not, by itself, evidence of a bargain. It might simply be evidence that the market is correctly revising down its estimate of the asset's value as new negative information emerges. A true bargain is one where the decline in price has been excessive, where it reflects fear or ignorance, rather than a genuine deterioration in fundamental value. Where are true bargains most commonly found? Marx identifies several characteristic hunting grounds. First, they are found in assets that most investors are ignoring, what he calls obscure investments. These are typically found in less well-followed corners of the market, smaller companies, less liquid bond markets, complex financial instruments, or specialized industries where most investors do not have the expertise to analyze them properly. Because fewer sophisticated investors are competing for these assets, pricing errors can persist much longer than they can in the heavily analyzed mainstream markets. The investor who is willing to develop genuine expertise in these less traveled areas has a significant informational and analytical advantage over the typical market participant. Second, bargains are found when companies or industries are experiencing financial or operational difficulties. When a company reports disappointing results, or when an industry faces structural challenges, or when a business is going through a complex reorganization or bankruptcy process, most investors flee. The social stigma of owning troubled assets is significant. The fear of further declines is real. The analytical complexity of understanding distressed situations is a deterrent to most investors. All of these factors combine to create a seller's market where prices can fall well below intrinsic value simply because the number of willing buyers has collapsed. The investor who is willing to do the work, to understand a distressed situation deeply enough to assess the true value of the assets and the likelihood of recovery, can find exceptional opportunities that the casual, comfort-seeking investor will never see. Third, and most dramatically, bargains arise during broad market crises and panics. When financial markets experience a genuine systemic shock, as they did in 2008, as they did briefly in early 2020, as they did during the Asian financial crisis and the Russian default and the long-term capital management crisis of 1998, virtually all assets are sold indiscriminately. Even the highest quality, most financially sound businesses and assets see their prices decline sharply, simply because investors are desperately raising cash, reducing leverage, and running from risk, regardless of the specific merits of individual positions. These moments are genuinely terrifying. The news is catastrophic. The uncertainty is extreme. The social and professional pressure to reduce risk, to hold cash, to avoid anything that might decline further is overwhelming. And yet, these are the moments when the patient, disciplined, capitalized investor can buy genuinely excellent assets at prices that in retrospect will look almost comically cheap. The best investments of the past several decades have been made in precisely these moments of maximum fear. There is a concept closely related to finding bargains that Marx calls patient opportunism, and it is one of the most practically important ideas in his entire framework. Patient opportunism is the practice of maintaining discipline and waiting for the right opportunities rather than being compelled to invest continuously regardless of the attractiveness of available opportunities. Most investment managers feel an enormous pressure to be fully invested at all times. Clients who see their manager holding significant cash during a rising market feel that they are not getting value for their management fees. They wonder why they are paying someone to hold their money in low-yielding cash when the market is going up. This pressure leads managers to invest in things they would not otherwise buy, simply to appear active and to avoid the embarrassment of having too much cash during a bull market. Marx resists this pressure emphatically. He believes that cash is a legitimate asset class with an important role in any intelligent portfolio. When genuinely attractive opportunities, meaning investments, with a significant margin of safety and an attractive risk-adjusted expected return, are not available, it is perfectly rational and indeed superior behavior to hold cash and wait. The expected return on cash, while low, is better than the expected return on an overpriced asset. And cash has the enormous advantage of optionality, meaning it can be deployed quickly when the right opportunities do arrive. The investor who is holding cash during a market downturn is not the one who missed out. They are the one who preserved their capital and now has the ability to deploy it at the most attractive prices. This is easier said than done at the institutional level, where the pressure from clients and boards of directors to be invested is constant and powerful. But at the individual level, there is no reason why an intelligent investor cannot practice patient opportunism. You do not have to buy something just because you have money to invest. You can wait. You can maintain your standards. You can refuse to compromise your criteria for a margin of safety just because the market is not currently offering investments that meet those criteria. Waiting for the right pitch, to use a baseball analogy that Buffett is fond of, is one of the most important disciplines in long-term investing. Now, let us examine what is perhaps the most underappreciated but deeply important aspect of Marx's framework: the role of knowing what you do not know. In a world that is saturated with confident financial forecasters, with economists making precise predictions about growth rates and interest rates, with strategists saying exactly where the stock market will be at year-end, with pundits expressing certainty about outcomes that are genuinely uncertain, Marx stands apart by his intellectual honesty about the fundamental limits of forecasting. He distinguishes between two types of knowledge. One type consists of things that can be known with reasonable confidence. Facts about the current state of a business, its balance sheet, its cash flows, its competitive position, its management team. Historical data about how similar businesses have performed in similar environments. Broadly observable trends in technology, demographics, or regulation. These are things that careful research can establish with reasonable confidence, and making investment decisions based on thorough research into these knowable facts is the foundation of sound investing. The second type consists of things that fundamentally cannot be known with confidence, no matter how much data you gather or how sophisticated your models are. Where will interest rates be in 2 years? When will the current economic cycle turn? How will geopolitical events affect global trade and financial markets? How will consumer behavior change as technology evolves? These are questions with no reliable answers. They involve too many complex, interacting variables, too many genuinely unpredictable human decisions, too many random shocks that no analysis can foresee. And yet, investment managers are constantly being asked to have views on exactly these questions, and the professional culture of the investment world rewards confident forecasters even when the evidence that they can actually forecast these things reliably is essentially non-existent. Marx argues that acknowledging this uncertainty is not a weakness, it is a strength. The investor who pretends to know what cannot be known will inevitably make bold bets based on that false confidence and will periodically suffer devastating losses when reality diverges from the confident forecast. The investor who accepts deep uncertainty about the macro environment and focuses instead on building positions with enough margin of safety that they can survive a wide range of macro outcomes is much better positioned to compound wealth over time. This philosophy leads to a clear set of practical implications for portfolio construction. Rather than making a bet on a particular macro scenario and building a portfolio optimized for that scenario, the uncertainty-aware investor builds a portfolio that should do reasonably well across many different scenarios. She diversifies not just for the traditional reason of reducing company-specific risk, but for the deeper reason of reducing the impact of macro forecasting errors. She ensures that each individual position has a margin of safety large enough to absorb a reasonable amount of uncertainty about the macro environment. And she avoids using leverage, because leverage amplifies the damage done by any macro forecast that turns out to be wrong. This connects directly to Marx's views on diversification. He is not a proponent of extreme concentration, of putting the majority of your portfolio in a very small number of positions based on high-conviction ideas. While he respects the approach when it is practiced by investors who genuinely have superior information and analytical ability in specific areas, he argues that for most investors, the potential damage from a single large mistake in a concentrated portfolio far outweighs the potential benefit from a few outsized wins. The defensive portfolio, the one that never suffers a catastrophic loss, will almost always outperform the aggressive concentrated portfolio over a long enough time period, because the defensive portfolio is always in the game, always compounding, never suffering the setback that requires starting over. He makes the mathematical point explicitly, though let us state it in words. If you start with 100 units of capital and you lose 50%, you need to gain 100% to get back to where you started. You have lost not just the money, but all the time and all the compounding that would have occurred during the period needed to recover. The investor who never loses 50%, who never loses more than 20 or 25% in even the worst environments, starts each recovery from a much higher base and spends much less time digging out of holes. Over a career of investing, the avoidance of catastrophic losses is worth far more than any single extraordinary gain. Let us now turn to the profoundly important topic of investor psychology and the systematic biases that cause even intelligent, well-intentioned investors to make poor decisions repeatedly. Marx is deeply influenced by the field of behavioral economics, which studies how actual human decision-making differs from the idealized rational behavior assumed by classical economic theory. And he applies the insights of behavioral economics with particular force to the specific challenges of investment decision-making. The first and most pervasive bias is what psychologists call recency bias, meaning the tendency to give too much weight to recent events and too little weight to long-term historical patterns. In investing, this manifests as the tendency to assume that whatever has been happening recently will continue to happen. If stocks have been going up for several years, most investors intuitively expect them to continue going up. If a particular sector has been dramatically outperforming, most investors assume it will continue to outperform. This recency bias causes investors to buy after assets have already risen significantly, when expected future returns are lowest, and to sell after assets have already declined significantly, when expected future returns are highest. It is the fundamental engine of speculative bubbles and panics. The bubble forms as rising prices attract more buyers, who push prices higher still, confirming the expectation of continued rises. The panic forms as falling prices frighten more sellers, who push prices lower still, confirming the expectation of continued declines. The second major bias is loss aversion, which behavioral economists have studied extensively and which has particularly powerful effects on investment behavior. The research consistently shows that people feel the pain of financial loss approximately twice as strongly as they feel the pleasure of an equivalent financial gain. This asymmetry has profound consequences. It causes investors to hold on to losing positions far too long, in the hope of avoiding the psychological pain of crystallizing a loss, even when the rational decision would be to sell and redeploy the capital more productively. It causes them to sell winning positions too quickly, taking the gain before the full potential is realized, in order to lock in the pleasure of a profit before it can turn into a loss. And it causes a general aversion to investments that have a meaningful probability of showing short-term losses, even when the long-term expected return is excellent. All of these behaviors, driven by loss aversion, tend to reduce actual investment returns relative to what a purely rational strategy would achieve. The third major bias is confirmation bias, the deeply human tendency to seek out and embrace information that confirms your existing beliefs while unconsciously dismissing or minimizing information that contradicts them. Once an investor has formed a view on an investment, the natural human instinct is to find evidence that supports that view. They read the bull case carefully and the bear case dismissively. They talk to sources who share their perspective and avoid those who challenge it. They interpret ambiguous information in the light most favorable to their existing position. This makes it very hard to recognize when you have made a mistake and very easy to maintain positions that should be abandoned long past the point where a clear-eyed review of the evidence would demand a change. Great investors are distinguished, among other things, by their willingness to update their views in response to new information, even information that contradicts their existing position. This is genuinely difficult because it requires overriding the confirmation bias that is working constantly to preserve the current view. But the ability to change your mind when the facts change, without ego, without embarrassment, and without excessive attachment to the original thesis, is one of the most important intellectual virtues an investor can cultivate. The fourth bias that Marx discusses is particularly relevant to professional investors, and that is the fear of looking foolish. As he has observed over his long career, many investment decisions are driven not by a pure assessment of risk and return, but by a calculation of how the decision will look to others if it turns out badly. Making a conventional decision that turns out badly is much more professionally comfortable than making an unconventional decision that turns out badly. If you buy a stock that every major analyst is recommending and it falls 50%, there is always the defense that everyone got it wrong. You are not uniquely foolish. But if you buy an unpopular, out-of-favor stock on a contrarian thesis and it falls 50%, you look like an idiot who went against the wisdom of the crowd and got burned. Even if the contrarian thesis was analytically sound and the outcome was simply bad luck, the social and professional consequences are harsher. This asymmetry in the social consequences of conventional versus unconventional decisions creates a powerful bias in the professional investment world toward making safe, consensus-driven choices. The rational professional choice, in terms of career preservation, is often very different from the rational investment choice. And this divergence between what is best for an investment manager's career and what is best for the clients whose money they manage is one of the most important structural problems in the investment management industry. Individual investors who manage their own money are largely free from this particular pressure. They do not have to explain their decisions to skeptical clients or defend their unconventional positions to a board of directors. They have the freedom to be genuinely contrarian without the career consequences. This is actually a significant advantage that the thoughtful individual investor has over many professional managers, and it is one that is rarely recognized or exploited. Marx also spends considerable time on the subject of what he calls groupthink in investment markets. When a view becomes widely accepted in the investment community, there is enormous social pressure to conform to it. Challenging the consensus requires courage, because it means publicly disagreeing with many intelligent, experienced people and accepting the social friction that comes with being seen as contrarian or contrary. Most people, in most contexts, are deeply uncomfortable with this kind of social friction. They go along with the consensus, even when their own analysis suggests the consensus might be wrong, simply to avoid the discomfort. This herding behavior, the tendency for investors to cluster around consensus views, is one of the most important drivers of market inefficiency. When everyone believes the same thing and everyone acts on that belief, asset prices can diverge dramatically from fundamental value. And the more widely shared the consensus, the greater the potential mispricing, because there are fewer skeptical buyers and sellers pushing back against the crowd. Understanding that widespread consensus often implies mispricing is one of the most practically useful insights in Marx's work. The antidote to all of these psychological biases, Marx argues, is a disciplined, systematic investment process. A good process forces you to ask the same set of questions for every investment, regardless of how excited or how fearful you feel about it. It forces you to consider both the bull case and the bear case with equal rigor. It forces you to quantify the margin of safety and to compare it against a consistent standard. It forces you to think about what you might be missing, about what the smart investor on the other side of your trade is thinking. And it provides a framework for making decisions that is grounded in analysis rather than in emotion. Process is not a guarantee of success. Even the best process will produce some bad outcomes, because investing is inherently probabilistic, and even the best decisions sometimes produce bad results due to factors outside anyone's control. But a rigorous, consistent process, applied over many decisions, over many years, will produce superior results on average, compared to a more intuitive, ad hoc approach. The value of a good process is not in any single decision, but in the aggregate results it produces over time. Marx is also emphatic about the importance of a long time horizon in investing. Many of the principles he advocates, buying when others are fearful, holding through volatility, waiting for value to be recognized, being patient when opportunities are not available, only work if you have enough time for the strategy to play out. If you are measured and judged on quarterly performance, if your clients can withdraw their money after a single bad quarter, if you are under constant pressure to show results in the short term, you simply cannot implement a genuinely long-term strategy. The structural demands of short-term accountability will override your long-term strategy every time. This is one of the most important practical constraints on implementing Marx's ideas, and it is one that he discusses candidly. For professional investment managers, the challenge of maintaining a long-term strategy in the face of short-term performance pressure is one of the hardest problems in the industry. The best managers have addressed it by educating their clients about their strategy and cultivating clients who understand it and are committed to it through market cycles. They have chosen clients who will stay with them through bad years because they understand that bad years are an inevitable part of any long-term strategy, and that abandoning the strategy at the worst moment is the most destructive thing a client can do. For individual investors, the challenge is different but equally real. The enemy of the long-term individual investor is not client pressure, but self-discipline. The temptation to check your portfolio too frequently, to react emotionally to short-term movements, to abandon a sound long-term strategy because it has been painful for 2 years, is just as powerful as external pressure. The individual investor who can genuinely commit to a long-term strategy, who can hold investments for years without constantly second-guessing them, who can remain calm during market downturns and not sell at precisely the wrong moment, has a significant structural advantage that few institutional investors can match. Let us now spend some time on the specific question of the credit cycle, a topic that Marx knows better than almost anyone, and which has enormous implications for investors across all asset classes, not just those who invest directly in credit instruments. The credit cycle is the cycle of availability and cost of borrowed money in the financial system, and it has an enormous effect on asset prices, on economic activity, and on the risk environment for every investor. When credit is readily available and cheap, and lending standards are relaxed, a number of things happen simultaneously that create a dangerously elevated risk environment. Businesses and individuals can borrow to fund investments they otherwise could not make. This additional demand for assets, funded by newly created debt, pushes up asset prices. Rising asset prices create collateral that supports more borrowing, which creates more demand for assets, which pushes prices higher still. The leverage in the financial system increases. And as prices continue to rise and returns continue to be positive, investors become increasingly comfortable with the risk they are taking, increasingly convinced that the good times will continue, and increasingly willing to relax their standards further in the search for yield. This is the environment that Marx has described as the most dangerous in finance. It is dangerous not because it feels dangerous, but precisely because it does not feel dangerous. Confidence is high, returns are strong, credit is available, the future looks bright. And it is in this environment that the greatest risk is building up, slowly and invisibly, beneath the surface of apparent prosperity. Every additional dollar of leverage in the system is another link in a chain that will break when conditions change. Every relaxation of lending standards is another vulnerability in a structure that needs everything to go right in order to hold together. The reversal of the credit cycle is almost always faster and more violent than the expansion was gradual and gentle. Credit cycles tend to turn suddenly, often triggered by a shock that seems small at first. A wave of mortgage defaults that appears contained, a sovereign credit problem that seems limited to one small country, a single large financial institution that runs into trouble. Initially, these appear to be manageable, isolated problems. But in a financial system with high leverage and loose standards throughout, these small initial problems quickly reveal the vulnerabilities that the good times had hidden. Lenders become cautious. Standards tighten suddenly and sharply. Borrowers, who are relying on the ability to refinance their debt, cannot do so. Forced selling begins. Asset prices fall. Collateral values drop. More forced selling is triggered. The downward spiral accelerates. Marx has lived through this cycle multiple times, and each time he has observed the same pattern. Excessive optimism and relaxed standards during the expansion, followed by a sudden, sharp reversal that reveals all the hidden vulnerabilities, followed by excessive pessimism and extremely tight standards during the contraction, followed eventually by a new expansion as conditions stabilize and fear gradually gives way to cautious optimism. Understanding this cycle, observing its current phase, and adjusting your risk-taking accordingly is one of the most practically important things a serious investor can do. The credit cycle is closely related to what Marx calls the standard for investment quality. During the expansion phase of the credit cycle, the standard that investors and lenders apply gradually deteriorates. Deals that would have been rejected at the beginning of the cycle are accepted with only minor modifications later. Structures that would have seemed reckless in a more cautious environment become standard practice. The relentless search for yield drives investors to progressively more marginal opportunities. And crucially, because the environment has been benign for an extended period, no one has suffered the consequences of relaxed standards yet, which makes it easy to justify the relaxation. This pattern of deteriorating standards is one of the clearest observable signals that the cycle is late and that risk is elevated. When you see investment deals being done on terms that were previously unacceptable, when you see money flowing into asset classes that did not exist or were not accessible to the broad market 5 years ago, when you see the language of investing shift from caution to confidence to certainty, these are warning signs. They tell you that the pendulum has swung far toward the greedy extreme, that standards have been relaxed to the point where the inevitable mistakes and defaults will be large and numerous, and that the patient, defensive investor should be preparing for the next phase of the cycle. It is important to understand that Marx is not trying to predict when the turn will happen. He freely acknowledges that he cannot do that reliably, and that no one else can either. What he is doing is assessing the environment and calibrating the amount of risk he is willing to take in that environment. When the environment is characterized by easy credit, high prices, relaxed standards, and widespread confidence, he takes less risk. He is more selective. He insists on wider margins of safety. He is willing to hold more cash and to forego investments that do not meet his standards. When the environment is characterized by tight credit, low prices, very conservative standards, and widespread fear, he takes more risk. He is willing to buy things that feel uncomfortable because his analysis tells him the price more than compensates for the risk. This discipline, applied consistently over decades, is what has distinguished Marks and Oaktree Capital Management's performance. Not the ability to forecast the future with accuracy, not the discovery of some magical investment formula, just the consistent application of a rigorous, thoughtful framework for thinking about risk and value, combined with the psychological discipline to act on that framework even when it is uncomfortable. We should now spend some time on the concept of adding value in investment management, which Marx addresses with unusual candor and intellectual honesty. The question seems straightforward. What does it mean to be a good investment manager? Surely, generating high returns is the answer? But Marx argues that this is only half of the answer at best, and the less important half at that. To understand what genuine value addition looks like, you need to consider not just the returns that a manager generates, but the risks they took to generate those returns. A manager who earns 20% in a year by concentrating all client capital in a single speculative bet has generated a great return, but has added no genuine value, and has in fact destroyed value by taking irresponsible risks that could have ended catastrophically. A manager who earns 12% in a year by carefully analyzing a diversified portfolio of undervalued assets with meaningful margins of safety has added genuine value, even though the absolute return is lower. Marx develops this insight into a broader framework for thinking about what superior investment management actually looks like over a full market cycle. He argues that the mark of a truly excellent investment manager is not the returns in a single year, not even the returns in several consecutive good years, but the performance across the full arc of a market cycle, including the bad years. Specifically, he argues that the characteristic of genuine excellence is the combination of participating adequately in the upside, meaning generating reasonable, but not necessarily the highest returns during bull markets, while protecting capital significantly better than the market during downturns. This asymmetric performance profile, good results in good times and much better relative results in bad times, is the signature of the kind of defensive, value-conscious, margin of safety-focused approach that Marx advocates. And it is far more valuable than the profile of the manager who earns spectacular returns in bull markets but suffers catastrophic losses in bear markets. The mathematics of compounding strongly favor the defensive approach over the long run, because avoiding large losses allows capital to compound consistently without the devastating interruptions that force the aggressive manager to spend years recovering from his worst periods. For the individual investor applying these principles to their own portfolio, the practical implications are clear and actionable. Build a portfolio where every position has a genuine margin of safety, where even in a bad scenario, the losses are manageable. Avoid leverage or use it only very sparingly and with great care. Maintain diversification sufficient to ensure that no single mistake can do catastrophic damage. Be patient and wait for genuinely attractive opportunities rather than constantly finding reasons to justify investing even when conditions are not favorable. And most importantly, invest in a way that allows you to stay in the game indefinitely, to never be forced to sell at the worst possible time due to financial pressure or emotional panic. Staying in the game is perhaps the ultimate expression of defensive investing. The great fortunes in investing are built not by making spectacular returns in any single year or any single cycle, but by compounding at a reasonable rate for a very long time without suffering the interruptions caused by large losses. The investor who earns a steady compound return over 40 or 50 years will accumulate extraordinary wealth, while the investor who swings between spectacular gains and devastating losses may end up with far less, simply because the losses erode so much of the capital that would otherwise have been compounding. This connects to one of the most important and least appreciated points Marx makes about the nature of investment success. The very best investors he has observed over his career are not necessarily the most aggressive or the most brilliant forecasters. They are not the ones who always had the highest returns in any particular year. They are the ones who were still in the game after 20, 30, 40 years. They are the ones who navigated every crisis without blowing up, who maintained their process through every period of market stress, who never made a single mistake large enough to end their career or destroy a significant portion of their clients' wealth. Longevity in this business is itself evidence of superior skill because the market is designed to punish those who take too much risk. Let us bring these ideas together in one final, comprehensive synthesis. Throughout everything Marx has taught us, certain themes recur with particular force. The theme of thinking more deeply and more independently than the crowd. The theme of understanding that price and value are not the same thing, and that the gap between them is where opportunity lives. The theme of risk as the full range of possible outcomes, rather than just the volatility of prices. The theme of cycles as self-correcting systems that create both dangers and opportunities. The theme of the emotional pendulum and the necessity of acting against it when it is at extremes. The theme of patience as a genuine competitive advantage in a world of short-term thinking. The theme of intellectual honesty about the limits of what can be known and the importance of building in margin of safety to compensate for what we do not know. And the theme of defensive investing, of protecting capital as the primary priority, of building a portfolio that can survive the inevitable crises and corrections that every market will periodically experience. These themes are not independent ideas. They are facets of a single, coherent philosophy of investing that is grounded in a deep understanding of human psychology, of market dynamics, and of the relationship between risk and reward. They reflect a way of thinking about investing that is genuinely different from the way most investors think, not because it involves exotic strategies or complex instruments, but because it involves a different fundamental orientation. Instead of asking, "How much can I make?" it asks, "What can go wrong?" Instead of following the crowd into what feels safe and comfortable, it looks for opportunity precisely where the crowd has created mispricing through fear or greed. Instead of making confident forecasts about an inherently uncertain future, it focuses on finding assets that are cheap enough to be attractive across a wide range of future scenarios. This philosophy is not a recipe for becoming rich quickly. It does not offer spectacular returns in short time periods. It does not promise excitement or the thrill of a concentrated bet that multiplies your money many times over. What it offers is something more valuable, a rational, disciplined approach to building wealth over the long term by consistently finding assets that are priced below their intrinsic value, managing risk carefully and honestly, avoiding the catastrophic mistakes that destroy capital and require years of recovery, and compounding those avoided mistakes into a steadily growing base of investment capital. If there is one sentence that captures the essence of Howard Marks's life work as an investor, it might be this. In the end, what determines the success of an investor is not the brilliance of their forecasts, not the sophistication of their models, not the exclusivity of their information, but the quality of their thinking, the honesty of their risk assessment, and the discipline of their process in the face of a world that is always uncertain, always more complex than any single framework can fully capture, and always more influenced by human emotion than pure logic would suggest. The market is a humbling place, and the investors who thrive in it over the long run are almost always the ones who have accepted that humility, who have acknowledged the limits of their own foresight, who have built their strategies around the recognition of uncertainty rather than around the false confidence of prediction. They are the ones who have learned to be comfortable with discomfort, to find opportunity in fear, to exercise caution in euphoria, and to remain patient, disciplined, and grounded in their process through every cycle that the market throws at them. This is not a passive or defeatist approach to investing. It is, in fact, the most demanding approach possible because it requires you to constantly override your most powerful instincts, to think deeply when the crowd is thinking shallowly, to remain calm when the crowd is panicking, to be cautious when the crowd is excited, and to maintain rigorous standards when the crowd is relaxing them. It requires the rare combination of intellectual depth, emotional discipline, and psychological fortitude that characterizes the truly great investors of every generation. And yet, for all its difficulty, it is also the approach most likely to produce lasting results. Not in the next quarter, not necessarily even in the next year, but over the full arc of a career in investing, over the many cycles that markets will move through, over the crises and recoveries and bubbles and panics that will inevitably occur in the decades ahead. The investor who genuinely internalizes these principles, who builds them into a rigorous, consistent process, and applies that process with patience and discipline through good times and bad, has the best possible chance of achieving the kind of long-term investment success that compounds into genuine, lasting wealth. And that, ultimately, is what Howard Marks is teaching. Not a formula, not a shortcut, not a prediction, but a way of thinking, a framework for seeing markets clearly, a set of principles for making better decisions under uncertainty, and a philosophy of investing that stands the test of every market cycle because it is grounded not in any particular market condition or economic theory, but in the enduring realities of human nature, of risk and reward, of price and value, and of the patient, disciplined application of careful thinking in a complex and always uncertain world. If you carry nothing else forward from all of these ideas, carry this. Think at the second level. Understand that in investing, being right is not enough. You have to be right in a way that the market is wrong. Know the difference between price and value, and never confuse one for the other. Understand risk as the full range of what can happen, not just as the probability of the worst case. Respect cycles, both economic and psychological, and use your awareness of them to guide your positioning. Be genuinely contrarian when your analysis supports it, because that is where the real opportunities lie. And always, always protect your capital first, because the investor who never suffers a catastrophic loss is the investor who can compound wealth across decades. And it is in the compounding across decades that truly extraordinary investment results are made.